$100 here, $200 there. You feel responsible, disciplined, financially mature. But one day you open your banking app and notice something strange. Your savings account has $10,000 sitting there, earning only 0.5% interest, which means you made just $50 in a whole year. Meanwhile, you keep hearing people talk about investing, stocks, index funds, and compound growth. And suddenly you wonder, wait, am I doing this wrong? Saving is great, but saving alone rarely builds real wealth. Most people know saving is important, but they have no clue how to transition into investing. In this video, I'm going to show you the exact path to turn your savings into investing without feeling overwhelmed or risking your financial security. Saving money alone almost never makes you wealthy. It protects your money, but investing grows it. Let's look at the numbers. $10,000 in a savings account at 1% interest becomes $10,100 after a year. The same $10,000 invested in the stock market at 10% annual return becomes $11,000. That difference seems small at first, but over 20 years, the savings would grow to about $12,200, while the investments could grow to around $67,000. Same starting money, completely different outcome. Most wealth gaps aren't between savers and spenders. They're between savers and investors. The reason most people don't start investing is psychological. Savings feel safe because the money is visible and stable, while investments fluctuate, which can be scary. That's why the transition should happen gradually. Before you invest a single dollar, make sure you have 3 to 6 months of living expenses saved in cash. This emergency fund is not for investing. It's for unexpected situations like job loss, medical bills, or car repairs. It protects your investments from being sold too soon. Next, separate your money mentally into 2 buckets: safety money and growth money. Safety money is protected, growth money is allowed to fluctuate. This mental separation reduces anxiety and makes investing feel less risky. You don't need thousands to start. Many platforms allow you to begin with just $50 to $100. The goal at first is to build the habit of investing consistently, not to chase massive profits. Focus on simple investments. Avoid complex strategies like day trading. Options or crypto speculation. Index funds are perfect for beginners. They are simple, diversified, low risk, and historically provide long-term growth. Even legendary investors like Warren Buffett recommend low-cost index funds for most people. Start small, invest regularly, and let compounding work in your favor. For example, investing $300 a month over 25 years could grow to roughly $285,000, even though you only contributed $90,000. The remaining $195,000 comes from growth, which shows the power of consistent investing. Investing can feel uncomfortable at first, especially when markets fluctuate, crashes happen. But long-term investors actually benefit from downturns because they buy more shares at lower prices, which can lead to stronger returns when the market recovers. Discipline and patience separate successful investors from gamblers. To summarize, first build your emergency fund, then separate your money into safety and growth buckets. Start investing small amounts consistently. Focus on simple long-term investments like index funds, and stay disciplined while giving your investments time to grow. Saving gives you stability, but investing gives you freedom. Combine both early, and your financial future becomes far more powerful. If this video helped you understand how to turn saving into investing, make sure to subscribe to Casual Finance Tips and let me know in the comments, are you currently saving or have you already started investing?